Okay, folks, welcome back. This is our midweek review for April 1st, 2020. The remaining portion of our economic calendar for this week shows, as we have here, tomorrow, April 2nd, 8:30 a.m., medium impact Canadian dollar trade balance, and the one that's going to be very, very impactful, the high impact U.S. dollar employment claims. As you can see, the forecast is rather significant. I'm expecting that number to be, well, higher than that. 4:30 a.m., medium impact on Friday, GBP, final services PMI. And 8:30 a.m., high impact average hourly earnings and non-farm payroll and unemployment rate. 10 o'clock a.m., ISM non-manufacturing PMI for dollar. Okay, so we have our dollar daily chart here, and I want to point out a couple things. If we have the atrocious unemployment claims number really just completely decimate forecasts, we could really see the dollar index really get smashed over the next 2 days here and come back down into this area. So we have a fair value gap in the form of a BISI, buy side imbalance, sell side inefficiency, and it's also a balanced price range. So if we lose, this area and go below here, man, that's really, really bearish for dollar. I suspect that we're probably going to reach down into that based on the numbers, as I mentioned last weekend when I was discussing the economic state of affairs in the U.S. A lot of unemployed Americans were unable to actually file through the unemployment claims website. It was down because of the volume of people trying to file. So I don't know. I haven't been able to check on the status of that, see if it's been rectified, if it has been a continued source of bottlenecking. But regardless, we're probably going to see a great deal of unemployment number American claims register tomorrow. So I suspect also all the jobs that this current presidential administration boasts about having created, I think that's going to be a thing of the past, like the stock market gains since 2016. So for your own edification, you can go and look up how many jobs the current administration shows in its quote-unquote building of jobs, and then how many we actually lose between last week's and this week's claims. So we have a balanced price range in here. We have the BISI here, and then we have a SIBI. So the fact that we ran through the 100.77 and 99.83 levels with one singular candle, we should not see price trade through the mean threshold of both of these candles. Okay, in other words, whatever that range is, as defined here, okay, we're splitting that in half, and price, if it does spike, it should not go above that. Now, if it does and closes above that, that's actually a bullish scenario. It's really hard to assume any reason to be bullish because we've had a great deal of stimulus more or less provided, and we haven't really seen a whole lot of reaction to it yet. So I think what the market's waiting on is these unemployment claims, because that's going to be the real indication of the state of affairs in the U.S., and it's probably way more than most people realize. Our country's in a standstill. Okay, so nothing's really generating revenue except for the grocery stores, and thank God for the people that work in those stores, because if my family members were doing those types of jobs, I would be saying, no, you're not doing that. Okay, you just stay home and I'll take care of it. But that's the sad state we're in. Some of these individuals are just stuck doing it. They either come in or they're going to lose their job. So I continuously keep those type of employees and Americans, and not only in America, really, it should be everyone, in all other countries, they should be prayed for, because they're risking their life. They're risking their health. They're not only risking their health, but their family members. So a great deal of admiration for those individuals, as well as the healthcare providers. So if we see the unwillingness to go back through the midpoint of this balanced price range, okay, we're looking for this lower end here. And if we get below here, that is exceedingly bearish for the dollar. And that would take us down into potentially the 92s, which if we do go below here, that's where I'm looking for. I don't think we're just going to go below this shallowly. I think it'll be a significant decline. Now, I'm not saying that's going to beeline straight for it, okay, on Thursday and Friday. I don't suspect that's the case. But over time, I think April may want to make an attempt to get down there. And it might do it in pretty big ranges, but again, not in 1 2-day period, okay? We have the volume imbalance in here. We traded through that. I find it interesting right now at the time of this screen capture, it was right there. Now, I didn't try to do that on purpose. I just happened to notice that is, in effect, closing in the volume imbalance, even though we've had multiple passes with the wicks. I would rather see it close that up and leave a body in that little area right in here. And that officially rebalances that. And also it's been met with significant inability to get above that 99.83 level. It spiked through a little bit, but then gave up the ghost. So we'll see if the economic numbers tomorrow provide the push lower, and it's real hard to be bullish in this scenario. Dollar 60-minute chart. You can see that imbalance in here. Nice reactions. And then we have sell side liquidity here, and then that lower level fair value gap, and I've provided consequent encroachment in here. So the level that's actually being highlighted here for your notes is 97.01. So in form of precision, if we're watching that, I want to see if it get down into that level and touch it, if it not go through it entirely. So we're looking for continuation on the lower end on dollar. Otherwise, if the market does something completely unexpected, which would be almost miraculous at this point, we're looking for lower prices. 15-minute time frame dollar. I like the equal highs in here. We've rated back up into that fair value gap. And again, this is the low end of that balanced price range on the daily chart. Created a fair value gap in here, consequent encroachment there, and rally down below. We've just about closed up this little area here on the bullish order block, and I think watch this one here on the 15-minute time frame, and then ultimately we have this low and this low. So we have 98.80 institutional and sell side liquidity in the crosshair, so be mindful of that. Consolidation, reaccumulation, equal highs, smart money reversal, low risk sell here, and there should be another area distribution in this with the breaker. So if we go lower, come back up, watch 99.50, 99.45 as a potential 15-minute additional selling opportunity, and see if that happens, and then watch how it rolls through to clear out the sell side liquidity below here. So we're looking at a market maker sell model in here on the 15-minute time frame. Moving on into the euro dollar. This is our daily chart. As I mentioned on the weekend review, I said that we've basically made it to mean threshold of the bearish order block, and at the same time it was finding its way at the mean threshold of the bullish order block on the Dixie or dollar index, relative again to its daily chart respectively. So I mentioned that we probably may see it reverse and go lower, and if it did, we'd come down here and trade into this imbalance, and it has done so in stunning fashion. Monday, Tuesday, and Wednesday's trading almost completely closed in the imbalance. So this fair value gap in the form of a BISI, buy side imbalance, sell side inefficiency, is pretty much filled in. If we go lower any more than that, it takes us back to the idea I mentioned on the daily chart for the dollar index. That would suggest maybe a run into the consequent encroachment of that recent SIBI or mean threshold of the balanced price range. Both are essentially almost the same price level, but for the dollar to get there, then it would probably completely fill in the BISI here for the euro. I don't suspect that that's going to happen. I think that we've made an attempt to get down here, almost consequent encroachment, went a little bit lower, didn't quite get down to it. And if we trade higher from here, that's really bullish because we left the fair value gap open, and this would be a breakaway gap. And not to say that the euro is any better in terms of an economic situation, because they're about to have their clock cleaned too because of all the numbers of the sick and failing and falling over there. So, you're kind of damned if you do and you're damned if you don't in terms of picking what currency is which. Worst case scenario, and I'm going to suggest this as the possible scenario that's unfolding, because we're going to talk about cable in a couple minutes. Dollar index may fail and go lower. Okay, that's our assumption, or my assumption. That's what I'm assuming is going to happen. Euro may not actually be all that bullish. It may just be held in consolidation for Thursday and Friday. It might see a little bit of modestness in terms of upside, maybe trade into the 110s, 110.30, 110.40s. But it may be capped and not trade above this short-term high. But cable may see upside expansion, and that would be manipulation on the part of euro pound. Euro pound looks weak right now, has some sell side liquidity that it can run through, and also rebalance at a lower level, buy side imbalance, sell side inefficiency in the form of a fair value gap. So look at euro pound and study that one. I'm not going to give you any chart for that because I want you to look at it yourself and study it. But because that pair looks bearish, that's the reason why I'm suspecting that euro dollar doesn't really have all that much upside where we are right now. Now, obviously, that might change depending upon what the central bank does after it releases the numbers for the unemployment rate in the U.S. So, again, we are using the calendar to more or less time when volatility is going to come in, but because everyone's expecting horrible numbers, the central bank can always do something in the short term and upset sentiment. So again, it's not always a bearish economic report, therefore the currency goes straight down from there. Now, obviously that makes the most sense. That's what we're expecting to see, and we're in unprecedented times. It's just when we look at things like this, just know that while we're expecting lower prices on the dollar, it doesn't always equally translate to a higher euro. Euro may be held in consolidation between 111.40, 110.30, okay, the remainder of the week. Don't hold me to those numbers, but I'm just giving you as a hypothetical that's where it could stay in a range while dollar trades lower, but cable goes higher. And we'll talk about that when we get to cable. But if we do, and if I'm wrong, see higher prices and we get back above the breaker in here and the mean threshold of the bearish order box, which is what it traded to, excuse me. If we get above that, then we're going to go right into this area right in here, which is our next fair value gap in the form of a SIBI, sell side imbalance, buy side inefficiency. So that's what's being highlighted there. So around 112.50 mid figure, that's where it could potentially trade to. Should we trade above that? I don't suspect that's the case for the remainder of this week at least. And let's move over to the hourly chart. Okay, so you can see there's some buy side liquidity resting here, clean highs in here. So around that mid 110.50 level, it could spike up into that area. But I certainly don't believe at this moment that euro is going to see 111s or 111.43 at least this particular week. I think everything's lining up for euro pound to do its work and allow cable to potentially rally. All right, so here is the euro dollar 15-minute time frame, and we have again equal highs in here, small equal high as well, And nothing in here really excites me in terms of what it would want to reach for. We do have equal highs here, and that would just basically be if I'm completely wrong and they allow euro to rally with weakness in the dollar. But we came down into our imbalance. Consequent encroachment initially went a little bit lower. Didn't come completely down to the 109 big figure to close that all up. But we were trading now near the top end of that imbalance. So again, while I'm bearish dollar, I'm not terribly bullish euro at this moment. Cable daily chart, you can see here we had our fair value gap we mentioned in here. It's traded to that, found some resistance. Couldn't get really a lot of leg room to go higher. We had a Tuesday rebalance on the fair value gap that was formed after Monday's close. So we traded down to that, almost completely closed it in. Showed some willingness to want to go higher. Now this to me, plus the fact that we have a breaker here. So we have high, low, higher high, this wick, okay, or tail on this particular candle. I'm splitting that in half. That is consequent encroachment for the gap, that is the tail. Extending that out in time. That's the actual level I'm looking for to be traded to if cable rallies with weakness in dollar. This particular pair is showing a little bit more resilience. And again, not that the UK is in any better situation because they're losing a lot of people too. Their numbers are horrendous. Their leadership had the idea that he wanted to let everybody get it first, and then he changed his mind and he gets it. So I don't know why cable would want to rally except for just a manipulation on euro pound. So it's not that cable's any better than a dollar or that it's any better than a euro. Okay, it has its own share of issues, okay, and none of which are good. So just know that we're probably going to trade up into that breaker if we see some upside on it and weakness on the dollar. That's the particular level I'm looking at. The tail on this down close candle, split that in half from the close to the low. Extend that through all these candles, and that's the level I'm specifically looking for it to trade up to. If we get exceedingly weak data on dollar and dollar it just gets smashed tomorrow and Thursday, into Friday, this is where I'm looking for on large ranges for cable. Okay, that also would set the stage for everyone thinking that cable is a long-term buy, and this right here would be an area where I'd like to see it provide some selling pressure, and then euro pound be manipulated in the basis of that occurrence, and then euro would be allowed to trade freely then. But I don't think that's going to happen for euro until if we get weakness on the dollar and we trade up to this breaker on cable. On the 60-minute time frame, you can see we have multiple highs coming in here. It just looks like it wants to go higher. I don't think that it needs to go back down into 122s. There's no significance to get below this low here. I think it's going to be just held in consolidation and then waiting for the unemployment numbers to unfold, and then it takes off and reaches up into the levels I outlined on the daily chart. So nothing here looks weak. 15-minute time frame, again, nothing real noteworthy, nothing that stands out. Just everything I outlined on the daily and 1 hour chart. So really nothing to really speak of any importance. Moving into the SPOOs, the S&P E mini futures. I'm looking at the ES #1 exclamation point. Okay, so that's always the continuous contract showing. So there's really no gaps or sloppy price delivery. It's always a continuous delivery of candles. So that's the only reason why I'm using that one. But again, you would be trading the June contract if you were paper trading or actually trading. So I mentioned this level in here. That's our BISI, buy side imbalance, sell side inefficiency. And there's also a volume imbalance in there on the weekly chart. Not at these specific price levels, as I mentioned in previous recordings, but I said that we could possibly see that trade up into that if we get any kind of reaction to the stimulus package they released. But even with that, we've been unable to see SPOOs rally, which is understandable because, again, you can throw stimulus all you want, but the companies themselves are still hemorrhaging money. They're losing. They're not making money. There's no companies out there standing out saying, I'm making profits, I'm making revenue. And none of that's really occurring right now. And especially the big, large companies. There's more large blue chip companies losing right now than they are making, or even on the horizon, near term, turning the tide and seeing them become profitable. So even if they come out with some miraculous cure, okay, say that happens, and some vaccine comes into the hands of those individuals that are, spearheading all this, and it proves clinically that there is a scientific evidence that they have found a safe vaccination, and it's working, it's curing people, and it's preventing people from getting ill. Even that will get a sputter of bullishness then, but then you're left with the companies. Are they making money right away? No, nothing's changing. Okay, and there's going to be a period of unwinding all the anxiety, the uncertainty, and then waiting for leadership to materialize in equities again. Which companies are really back in the swing of things? Which ones have they really returned to their quote-unquote normal? And we're a long ways away from that. They have no idea how much impact this time has caused for our economy. Not just our economy, but all the economies that are affected by this. So it's real important that you don't try to follow these people online, okay, trying to pick a bottom on this, because they're all trying to look for that superstar award, that trophy, saying they called the bottom in the stock market crash of 2020. Avoid all that, okay? It's better for you to just expect lower prices. I've given you several levels that I think is, well, they're not cast in stone. There's nothing absolute about them. I just see, if we see continued weakness, 1750, 1700, and then ultimately if we just really start to lose ground. They mentioned a few times 100 to 250,000 people are expected to lose their life in America to this disease. So if that's true, that's horrible. But they also had thrown out another number saying that if they don't see all the states come together and do the same thing, we could lose in upwards of 2 million Americans. So that's a lot of people. It's going to be hard to understand the fallout of something like that if it occurs. And again, we are still left with this open-ended. How long is it going to take? What's the next shoe to drop? It's always that level of fear. And to me, if it doesn't significantly improve here in the next 2 to 3 weeks, we're looking for 1,000 on the S&P and below it. And to me, that's going into the fall. So again, it's not a right away type thing, but I just think nobody's willing to buy stocks. Nobody's willing. They can give you all the storylines they want about how the Warren Buffetts, all the hedge fund superstars in the past, they're all jawboning, they're buying. I don't believe that. I don't believe that at all. They have a vested interest in looking for people to want to buy it at higher prices. So if they can get, which is what they've seen here in recent days, a short-term little bounce, and it's not shown a lot of strength. To me, I think it's been short covering just below that 2,300 level, and we swept the 22 like I was calling for. It does not look bullish to me. It does not feel bullish. It doesn't feel like there's a low forming. There's absolutely zero reasons for stocks to have formed a low right here. It's done. Okay? Just have that in mind. Even if we are forming a low, I suspect that we're going to blow out the low that we've created here at the very minimum. Okay? And I don't think that's the case. I think we're going to go decidedly lower than that. On the 60-minute time frame, you can see we have our gap opening. I'll talk a little bit about that more when we get into the 15-minute time frame. But we opened, gap lower, traded back through it, found some support, rallied back up again, and just left this high and this high. Now, there's a lot of buy side liquidity resting in here, okay? So how we trade the rest of this week is, to me, very important, because if we lose the lows here, okay, if we trade below the 2400s, I don't expect these highs to be reached for in the near term. I think that they're just going to leave that intact and be done with it. This should have been exceedingly bullish to break out above that, and it didn't. It didn't happen. It just petered out, broke down, market structure break, rebalance, and went lower. So we do have, again, sell side liquidity resting in here, and then a larger pool of liquidity resting around that 2170, 2160 level. That's layered in here below that. So we'll see if there's any willingness to drive down there. I think it ultimately will be wanting to go down there. As we go into trading mid next week, maybe towards the end of next week, we should be down in that area. If, again, we don't see some monstrous sell-off, which very easily could happen with whatever news that comes out tomorrow and Friday. So let's move into the 15-minute time frame. Here's the gap opening. And you remember this lesson when I was discussing, we started talking about the S&P market pretty frequently a couple months back, and I said when equities open up like this and you have a gap opening, you want to know that gap and extend it out in time, because what happens is we gapped opening, there was no price data in here from the previous Friday's close to the next session open. Whatever the highest high is here when it gaps down, that's what you're looking for to frame your gap. Extend that out in time and you'll see what happens is the market will rally up, offer buy side through the gap. Okay, is that balanced then? No. Later on, after it makes a little bit higher high, it trades back down through it. So this gap offered buy side, it went a little bit higher, but then right in here it offered sell side. So buy side, sell side. Now think about what I showed you on the dollar daily chart. Remember, it had that one big single candle up offering buy side, which is in the form of a buy side imbalance, sell side inefficiency. Then it created most recently a sell side imbalance, okay, or a SIBI. Those two candles in the same price levels created a balanced price range. This has become a gap that has now become a balanced price range. Okay, so we traded up through it, and then they offered price down into it again. So this gap has been efficiently balanced here, and then price rallies. And then we start looking for gaps to get filled, bullish order blocks, up close candles to be broken and pierced. You see this up close candle here, price goes through that. Okay, that's bullish. That's institutional order flow. So every down close candle supports price. Every up close candle is broken. Okay, that's institutional order flow. That you don't need a depth of market, you don't need volume profile, you don't need all those gimmicks. Okay, we see, or I teach you how to see all the things that all those gimmicks are going to point to later on. Okay, they're going to happen later on. I'm telling you how to see it before all those other things. Retail, okay, they think it's a step up from retail when they put those things on their chart, and it's absolutely just lipstick. This low is broken, market structure break, comes back up, distribution. What's this right here? Fair value gap. What is this right there? Institutional order flow entry drill. It has to just trade to this candle's high. It does so a little bit higher than that too, then sells off. What's this right here? The same thing. We have a fair value gap. This candle's high. All it needs to do is trade to that candle's high or a little bit higher. You can be a seller right there. Sells off. Same thing here. Imbalance. This candle's high is all it's got to trade to. It does so here. Sells off. Fair value gap. Fills it completely here. Sells off. Fair value gap in here. Fills it. Sells off. Consolidates a little bit lower. Bangs into it one more time. This fair value gap right here being traded to, say you shorted that one, what would your target be there? You're aiming for this old low here. So are you in a rush to lower your stop loss? because we haven't gone down into this low yet. There's no reason to start moving your stop. We haven't gotten down to a level where we're reaching into sell side liquidity. So this is where there's a strangle on those individuals that lower their stop, and then this one is really coming back for them right before the real move that drives lower below the low. It's also consequent encroachment of that old daily level. And again, go back to your daily chart for SPOOs, rewind a little bit, and you'll see what I'm showing here. Again, it's the consequent encroachment of that fair value gap on the daily, and price trades lower and comes back up into a breaker, high, low, higher high, down close candles, trades up into that midpoint, boom, hits it, sells off. I'm going to show you a 5-minute chart, give you a little bit more detail in here. We have a fair value gap as well, trades there, essentially just above consequent encroachment. I gave you 2 reference points in here. This is this high here and this low. So when you understand the PD array matrix, you need to see price trade to a premium market. Using that range, high to low, we're in consolidation. Price trades up into optimal trade entry. Okay, you can do this on your own charts. Trades into optimal trade entry, and more specifically, it's just trading above the 50% level, which would give us a premium market. It does so after running relative equal highs and bearish order block. Fair value gap, extend that out in time, it trades back into it again and breaks down. Fair value gap here, institutional entry drill, sell off. Fair value gap, sell off. Fair value gap, sell off. Here, return back to bearish order block, that's this one right there. There, and sells off and sweeps below that old low that I showed you on the hourly right back here. Okay, so you want to be looking at that type of price action when we're looking at SPOOs. Okay, so you want to have 9:30 on your chart, and you can see that we opened at 9:30 here. Equities markets opened at the time, and the initial run here is your Judas swing. It runs up to consequent encroachment, relative equal high. So this is basically what you see in London session trading Forex, and everything else becomes the same. And then this becomes the afternoon trend, because this is the morning trend prior to noon. Okay, so right before noon it creates its short-term low. During lunch it consolidates to retracement, and then you expect another leg when you're bearish lower, and it trades so as such. Okay, so it's 2 trends in a S&P trend day. Sometimes you'll get the first leg completely measured out as a measured move, and it would basically duplicate what you see here. Other times it won't. Sometimes you'll have the first trend of the morning go down, and then it'll consolidate. It'll go down a little bit shallow and then reverse. When it does that, you're sweeping below a significant old low on a higher time frame, and then there's a lot of short covering that causes that profile to occur. But we're looking for lower prices on SPOOs, so we're going to see a lot of this type of event. So when you're looking for S&P, I got a question, that's why I'm answering. How are we supposed to be looking at price action or studying the E-mini S&P? You want to do things like this. Your day begins at 9:30 in the morning for the S&P, and then treat that as the beginning at midnight when we're looking at Forex, and then this would be your Judas swing. So if you're bearish, you're going to be looking for preferably some initial Judas swing higher, and then breakdown, and then the afternoon trend, which is 1 o'clock to 4 o'clock, that usually is the kind of like the similar price action you see from a New York session when we're trading Forex. So like this would be the same thing you would expect to see in London session, creating a high today. We trade down into London close. Market retraces and sets up another leg lower, but this leg lower is a similar price leg that we would see in New York session, which would be a continuation of the London session high forming. So all of this price action, if I just changed the time and the date and just said this was a currency and this was the London session move here, you would have no problem understanding it. But the differentiation is with SPOOs, you have 2 sessions in the form of the AM trend and the PM trend. So you have the morning session and the afternoon session. And it's divided by basically the time between 11 o'clock in the morning and 1 o'clock in the afternoon. So those times are a gray area where you don't know exactly where the short-term highs and lows are going to form. You just anticipate them to occur. So the easiest fix is take your profits on the AM session at or just before 11 a.m. and be content with letting some of the move go without you. Wait throughout lunch and then start looking for moves after 1 o'clock in the afternoon. And if you do that, you'll start seeing the more pure price swings that take place in SPOOs. And with that, my friends, is going to be it for our midweek review. I will be tweeting tomorrow after the economic data is released for unemployment, and then I'll send you a chart through Twitter if there's something to watch that's meaningful or noteworthy. Until then, be safe, be careful, and I'll talk to you on the weekend.